The political shocks of 2016 had a profound impact on the global fixed income market. In the aftermath of Donald Trump's election victory, some commentators called the end of the 30-year bond bull market. So, what can institutional investors expect in 2017? Joining me today to discuss the opportunities in fixed income is David Bennett, Head of Investment Consulting at Redington Partners. Hello, David.
Morning.
Morning. As we move into 2017, what's your view of the credit market?
Well, last year was a fascinating year, as you just said in your introduction, and in the context of more government bond markets more widely, a large proportion of the world's government bond markets actually ended in negative yields. In this context, people are chasing yield. There's no doubt about that as a theme. And after a really rocky start in 2016, Q1 in particular, bond markets generally had a very good year, and credit markets especially had a very good year. And at the start of the year, we're seeing a situation where a number of markets, investment grade and high yield particularly, are seeing credit spreads coming in to levels which are starting to raise questions as to whether we can expect the same kind of performance in 2017.
So on high yield, where are you kind of seeing opportunities in the new year?
Well, the high yield market, if we divide that up into leveraged loans and high yield bonds, at the moment I think high yield credit spreads are probably too tight to really expect a reasonable return this year. There's still reasonable value in leveraged loans. But one of the themes that we saw last year was the idea of multi-class credit. This is where the manager can allocate between high yields, leveraged loans, structured credit. They can go between the US and Europe, and they can also use cash. And by being able to move around between these different asset classes, there are opportunities to avoid the pitfalls perhaps of the US dollar sector, the high yield market there being quite expensive, and to move into other areas where there's greater value available.
So this is an idea that an institutional investor will almost hand over the day-to-day management of the fixed income portfolio to an external manager.
Yeah, in terms of the asset class allocation, that's exactly right. One of the challenges for institutional investors, particularly pension funds with the trustee arrangements, is it's very difficult to make tactical moves between different parts of the credit spectrum. Whereas there are a number of managers who have evolved quite a strong skill set in terms of their ability to take defensive action if required. This is often known as absolute return investing, and an example of the sort of things that we'd expect managers to be trying to do as they see investment grade credit spreads tightening in, and they're thinking that the opportunities there are limited or the risk of underperformance becomes greater. They can reduce their exposure to that. They can reach what we call credit spread duration. That is the sensitivity of the portfolio to credit spread movements. They can move into cash to some extent, and they can also move into more complex securities, ones that offer, you've had to work a bit harder to find the yield. And they can also look at shorter dated assets where you might earn a good return, but only perhaps for 1 or 2 years, essentially just parking the money and waiting for opportunities to come along later in the year.
And one big advantage that institutional investors have is their long-term outlook, and something that's often called the illiquidity premium, where they can get a high yield on their investments because they're long-term holders of those. What areas are you seeing where institutional investors can take advantage of the illiquidity premium?
I think last year the two key areas were, well, not last year, the last few years actually, have been very hot, if you like, infrastructure debt and also commercial real estate debt. And there's no doubt there's been some really quite good opportunities in that area. I think you'll find many commentators observing that perhaps there's been a bit too much money chasing those mandates. As a result of that, you have two or three different problems. The first problem is that there's actually too much money chasing these assets, so it's quite hard to get the money into the ground. You might give a mandate to a manager in January and find that by Q2 you still haven't got very much invested. The second problem is that there are some quite significant lags between when you commit to invest and when you actually get the money invested. And a theme last year was volatility. I'm sure everyone remembers that. But if you imagine that you commit to an illiquid investment in 1 month, 2 months later you still haven't put the money to work, but the liquid market, the traded markets, has seen spreads widen a lot. You might be sitting there thinking, God, I wish I could move the money into the liquid stuff rather than the illiquid stuff. So there are some challenges there, and I think you have to be cautious about too much money chasing these assets.
And so, for an institutional investor looking at these assets, thinking, we'd like to take advantage of them, but there are the risks, as you mentioned. What would you advise is the best way to kind of get into those assets?
One of the themes last year we saw was a few managers developing the capability to offer a diversified portfolio of illiquid assets. So rather than having to commit on a particular day, I'm going to make an investment in one particular sub-asset class within the illiquid space, you actually give them a mandate where they've got the ability to go anywhere between perhaps as many as 8 and 10 different illiquid asset classes, as well as being able to invest in some liquid asset classes as well. So the advantage of this is that the manager will be able to make the decision at any point in time, do I think there's some very attractive opportunities available today in some of these illiquid assets? If there are, he'll go and invest in them. If they're not, he can either park the money in cash or in a more liquid asset waiting for opportunities to come along. And I think that's got a lot of advantages for particularly smaller pension funds or smaller institutional investors, ones who don't necessarily want to commit to one of the sub-asset classes today, knowing that if they make that commitment, the manager will invest that money come what may, even if perhaps it's become a bit expensive or too much money's been chasing it.
Okay, well, fascinating developments and something to look forward to in the coming year. David, thank you very much for your time today.
Thank you, Owen.